All right. Good morning, everyone. And again, welcome to the Funding Your Retirement Future class. My name is Raquel, and I will be your moderator for today's class. So we have a great presentation in store for you all today. Our speakers bring a wealth of knowledge on planning your retirement. We're joined today by Maria Marcos from the CalPERS San Jose Regional Office, Pascal Johanning with the State Social Security Administration, and Tiffany Vick with Savings Plus. Together, they'll be providing tips and strategies that will help plan for your retirement no matter where you are in your career. This class is designed to familiarize yourself with available funding options for your retirement future. Many financial experts believe you need 75 to 85% of your pre-retirement income to maintain your current standard of living in retirement. Your retirement funding may consist of these three sources: your CalPERS pension, Social Security if you are eligible, and personal savings through either the CalPERS 457 plan or Savings Plus. And with that, I'd like to welcome Maria, who will be covering the CalPERS pension and how to maximize it.
Thank you, Raquel. Good morning, everyone. As Raquel mentioned, my name is Maria Marcos, and I work in our San Jose Regional Office for 20 years as a retirement specialist. I'm very excited to be here today to present your CalPERS pension. So CalPERS was founded in 1939, and we have about 2.2 million members. 30.2% are our state members, 31.2% are public agency members, and 38.6 are school members. Also, CalPERS administer health benefits for over 1.5 million members. CalPERS Facts, or CalPERS Pension, is a 401A defined benefit plan. What it means is it will provide a lifetime benefit based on a formula, not based on how much you contributed into the plan. CalPERS also manage the funds. CalPERS funding sources: 55 cents comes from CalPERS investment earnings, 34 cents comes from CalPERS employers, and 11 cents comes from CalPERS members. CalPERS also offer three different types of retirement. We have service retirement, which is our normal or regular retirement. In order for you to qualify for service retirement, you must have at least 5 years of service credit and meet the minimum age requirement. Disability retirement, there is no age requirement. If you are not able to perform your job duties due to get hurt on a job-related injury, serious illness, then you may be able to apply for disability retirement, but you must have a required service credit. Industrial disability retirement, this is for our safety members or for members that their employer contract for this benefit. As long as your injury is work-related, there is no age minimum or minimum of service credit. So the three factors that we use to calculate your retirements are service credit, the number of years you have with your CalPERS employer, benefit factor based on the formula what your employer contract with CalPERS, and the third one is our final compensation. It could be the average of 12 months or 36 months. So what we do with these three factors, we multiply them together and the result is unmodified. Unmodified is the highest amount you can receive in retirement. Depending on the payment options that you selected, that amount will be reduced. So let's go ahead and go over the first factor, which is our service credit. So you control this part of your retirement calculation. You earn your service credit until your last day on payroll, and you earn it on a fiscal year basis from July 1st to June 30th. So if your time base is hourly, 1,720 hours equals 1 year of service credit. If your time base is daily, 215 days equals 1 year of service credit. And if your time base is monthly, 10 months equals 1 year of service credit. So let's go ahead and look at the example of how you earned your service credit based on monthly pay. So beginning of fiscal year, if you work full-time, you earn 1/10 of service credit until end of April. So May and June, there's no service credit earned because you already get your 1 year of service credit by end of April. Another example we have is, what if you work half-time? So if you work half-time, you earn zero point zero 0.05 service credit, and you earn it all the way through end of May and June. So if you continue to work half-time, your service credit will be equal to 0.06 year. Besides the service credit that you earned while you're actively employed, we have several types of service credit that you may be able to purchase. First, it's called redeposit of withdrawn contributions. Second, service prior to membership. Third, military service credit. And other types are leave of absence, like your maternity leave, paternity leave, temporary disability, or serious illness. So for more information with regards to our service credit purchase, the publication that you need to request from CalPERS or download from our website, it's called Publication 12 for more information. Also with our service credit, so the more service credit you have, the more pension you will get in retirement, the higher pension. And if you purchase your service credit early, your cost will be a little bit less. And as of January 1st of 2020, we changed a rule that you must pay in full your service credit before you retire. So the second factor that we use to calculate a retirement, it's called benefit factor. And this is based on the percentage of pay received for each year of service, based on your age and your employer's formula. So for example, your formula is 2% at 62. So your minimum age to retire is 52. Once you reach that minimum service credit and you're 52 or older, you can start collecting your retirement. And then the maximum age is 67. Once you reach age 67, that's when you get the 2.5 all the way across. But at age 62, that's when you get your 2%. For more benefit factors, for example, you have 2% of 55, you can visit our website for more information with regards to different types of benefit factors. The third factor that we use to calculate our retirement is our final compensation. This is the highest average pay rate, plus if you have any special compensation that's included on your final compensation. Your final compensation is based on your full-time pay rate, not your earnings. And it could be 12 or 36 consecutive months based on your employer's contract or your membership date. So we already went over the three factors: service credit, benefit factor, and final compensation. So to convert that formula into numbers, let's say, for example, you have 25 years and plans to retire with 2%. So you multiply the 25 times 2, that's 50%. And then you multiply that with your final compensation, which is the 4,366 and 67 cents. So your result is 2,183 and 34 cents. Looking at this example, let's say you get a pay rate increase. So if you wait 6 more months to maximize your retirement, your service credit increase, your benefit factor also increased to 2.050 instead of 2%, and your final compensation. So any increase of $100 or more in retirement, it's great. So this is something that you have to think about when you decide what is the best time for you to retire. Also, when you're retired, we have different type of payment options that we offer. First, it's called unmodified, which is the highest amount, no return of contributions. Second is a return of remaining contributions. This is in the event you pass before you exhausted the remaining balance of your member contributions, your beneficiary will get the balance in a lump sum. We also have 100%, 100% beneficiary with allowance increase, 50%, 50% with allowance increase, And our flexible beneficiary, this is if you want to give a specific percentage or dollar amount to one or more beneficiaries. So how to maximize your pension? Like I mentioned earlier, service credit, you control that part of your retirement calculation. You work a longer period of time and you earn your service credit until your last day on payroll. Benefit factor, you work until you reach your highest factor. And the third one is your final compensation. You work longer under the higher pay rate. So these are the three factors that you think when you plan your retirement, how to maximize them. How to start your planning now? Make sure that you create your MyCalPERS account. And on your MyCalPERS account, you can run future estimates. Know your benefit factor. Review or planning your service retirement or publication one. Take our classes and get a pension estimate with your retirement estimate calculator. Now this concludes my part of the class. Thank you.
Thank you, Maria. Our next up, we'll be joined by Pascal Johanning, who will walk us through the details and the role state Social Security plays in funding your retirement.
Welcome. My name is Pascal Johanning from the State Social Security Administrator Unit at CalPERS. One element to your retirement planning is Social Security. We want you to be aware of Social Security and how it can play a part in your planning. While some of you may not be contributing to Social Security through your current CalPERS covered position, you might still be eligible for benefits. In this presentation, we will explain how you may qualify for those benefits. Let's start with eligibility. How do you become eligible for a Social Security benefit? There are two ways to be eligible for Social Security. The first would be based on your personal work record, and the second would be based on your spouse's work record. If you are eligible for a benefit based on your own work record and your spouse's work record, then this is called dual entitlement. While you can't receive both benefits, the Social Security Administration will pay out the higher of the two. The benefit you would receive if you qualify through your spouse's work record would be 50% of your spouse's benefit. Let's go over each. To qualify for Social Security benefits based on your own work history, you need to earn what are called Social Security credits. You receive these credits when you work in a job and pay Social Security taxes. So how do you earn credits? In 2025, you earn 1 credit for every $1,810 in wages, up to a maximum of 4 credits per year. To be eligible for benefits, you need a total of 40 credits, which is typically about 10 years of work. Keep this in mind. Even if you are not currently paying into Social Security through your current employer, you may have earned credits from your previous jobs. If you have at least 40 credits from past employment where you paid Social Security taxes, you are eligible for benefits. You may also qualify for Social Security benefits based on your spouse's work record, provided you meet certain requirements. To be eligible, you must be at least 62 years old, and your spouse must already be receiving Social Security benefits. The spousal benefit can be up to half of your spouse's monthly Social Security amount. It's important to note that if you are eligible for benefits, both on your own work record and through your spouse, you will receive whichever benefit is higher, not both. Additionally, you may qualify for Medicare at age 65 based on your spouse's work history, even if you have never worked in a job that paid into Social Security. Your full retirement age, or FRA, is determined by your year of birth and plays an important role in calculating your Social Security benefit amount. For those born in 1937 or earlier, the FRA is 65. Here's how the FRA increases for those born after 1937. In 1938, your FRA is 65 and 2 months. 1939, 65 and 4 months. 1940, 65 and 6 months, and so on. If you were born between 1943 and 1954, your FRA is 66. For those born between 1955 and 1959, your FRA gradually increases. Please refer to the chart for your specific age. And if you were born in 1960 or later, your FRA is 67. Keep in mind, you don't have to wait until your full retirement age to start receiving benefits. However, starting earlier may reduce your monthly amount, while waiting longer can increase it. You can start receiving Social Security retirement benefits as early as age 62. However, if you choose to begin receiving benefits before your full retirement age, your monthly payment will be reduced. For example, if you start at age 62, your benefit will be about 25 to 30% less than it would be if you waited until your full retirement age of 67. The upside is that you will receive payments over a longer period. If you wait until your full retirement age, you will receive 100% of your calculated benefit. You also have the option to delay your benefits beyond your full retirement age. For each year you wait up to age 70, your benefit increases by about 8% per year. A common question is, when should I start collecting Social Security benefits? And there's no universal answer. It really depends on your personal circumstances. Here are some important factors to consider: your full retirement age and how your benefit is calculated, the impact of starting benefits early or delaying them, your life expectancy and how long you expect retirement to last, whether you plan to continue working, other sources of retirement income, such as pensions, savings, or investments, potential income taxes on your benefits, and how your decision might affect your spouse. To help you make an informed decision, you can use your My Social Security account to estimate your benefit amounts at ages 62, 67, and 70. This can give you a clearer picture of your options as you plan for retirement. So how does Social Security determine your benefit amount? The calculation can be complicated, so don't worry if it seems confusing. We will show you how to view your actual benefit numbers in the upcoming slides. Your benefit is based on your lifetime earnings from jobs where you paid Social Security taxes. To ensure fairness, those earnings are indexed to the average wage level 2 years prior to the year of first eligibility. So your early career income is valued in today's dollars. Social Security then looks at your highest 35 years of earnings to calculate your average indexed monthly earnings, or AMI. If you have fewer than 35 years of earnings, zeros are included for the missing years, which can lower your average. This is why it's important to understand how your work history affects your future benefits. Once your average indexed monthly earnings, or AMI, are calculated, Social Security uses a specific formula to determine your benefit. Here's how it works for 2025. You receive 90% of the first $1,174 of your AMI. You get 32% of the amount between $1,174 and $7,078. And you receive 15% of any amount above $7,078. These three amounts are added together to determine your monthly benefit at full retirement age. Please keep in mind, if you choose to start benefits early at age 62, your monthly payments will be reduced. If you wait and begin benefits at age 70, your payment will be higher. Also, a quick disclaimer: the dollar amounts used in this formula are updated annually. The figures shown here are for 2025. You can receive Social Security benefits while continuing to work, but your earnings may affect your benefit amount depending on your age. If you are under your full retirement age, there's an annual earnings limit. For 2025, that limit is $23,400. If you earn more than this amount, Social Security will deduct $1 from your benefits for every $2 you earn above the limit. In the year you reach your full retirement age, the earnings limit increases to $62,160. During that year, Social Security will deduct $1 from your benefits for every $3 you earn above this higher limit. Once you reach your full retirement age, there are no longer any earnings limits. So you can work and earn as much as you like without affecting your Social Security benefits. Additionally, as you continue working and paying Social Security taxes, your benefit may be recalculated each year. This means your monthly benefit could increase based on your additional earnings. I would also like to introduce a new law that went into effect earlier this year, the Social Security Fairness Act. To fully understand the Social Security Fairness Act, it is important to know how Social Security functioned prior to its enactment. If you work for a non-covered employer, meaning an employer who does not withhold Social Security taxes from your salary, your Social Security benefits may have been subject to certain reductions. The windfall elimination provision, WEP, would apply to you if you are a non-covered employee and qualify for benefits based on your own work record. On the other hand, the government pension offset, GPO, would affect you if you are a non-covered employee who qualifies for benefits based on your spouse's work record. The law that repeals the windfall elimination provision and the government pension offset was signed on January 5th, 2025. This legislation is retroactive to benefits payable starting in January 2024. However, it is still uncertain how long it will take to fully implement the changes. The Federal Social Security Administration is currently developing procedures and automated solutions for the new calculations. Ultimately, this should increase benefits for individuals who have worked for non-covered employers and qualify for Social Security. For further updates regarding the Social Security Fairness Act, please visit the SSA website at ssa.gov and subscribe for notifications. If you haven't done so already, we strongly encourage you to create a My Social Security account. It's a quick, secure, and convenient way to access your Social Security information, and it's an invaluable resource for retirement planning. To further protect your personal information, the Social Security Administration has strengthened its security measures. When you create or log into your account, you will be asked to use login.gov or ID.me. This extra step meets federal authentication standards and ensures your Social Security account remains safe and secure. Once you have created your account, you will have a convenient and secure way to access your Social Security information online. If you are not receiving benefits yet, you can view your earnings record, get personalized benefit estimates, retirement, disability, or spousal benefits, or you can replace your Social Security card. Some of you may remember when SSA used to send out a statement annually with your earnings record. They don't do that anymore. You will have to create an account and view it online. Here's the estimate tool that is probably the most useful for your retirement planning. In your My Social Security account, you can run estimates and get actual numbers. You can play around to see what you would receive if you retire early or defer retirement. You don't have to do the complex calculation yourself. You can pick an age that you want to retire and see if that amount will work for you and your retirement income sources. To get more information on Social Security, visit the website at ssa.gov. To get personalized information on your Social Security account, create and log into your My Social Security account. You can call Social Security directly at 800-772-1213. If you want to talk to someone in person, you will have to call to schedule an appointment at your local Social Security office. Walk-ins are no longer accepted. There are 3 ways to apply for benefits. You can file online, you can schedule a phone appointment, and lastly, you can schedule an in-office appointment by calling 800-772-1213. And you can apply 4 months in advance of your desired start date. And with that, I would like to thank you for your time and attention, and I'm going to turn it over to Raquel.
Thank you, Pascal. Let's go ahead and move on to our next speaker. You have many options when selecting retirement savings plan. Helping us navigate these options is Tiffany Vick, who will provide insights around savings plus plans and understanding the tax implications to those plans you choose.
Good morning, everybody. Thank you for joining us today. My name is Tiffany Vick, and I will be talking to you about Savings Plus. First, there is a quick disclaimer that I'd like to go over. I won't require you to read the entire slide, but the gist of it is that this material is not a recommendation to buy or sell a financial product or to adopt an investment strategy. And also investing involves market risk, including possible loss of principal. Determine your financial needs in retirement. So as a general rule, many sources suggest that you should plan for retirement income that is 80 to 90% of your income amount at retirement. The average state employee nearing retirement can count on 40% to 50% of their pre-retirement income being replaced by their CalPERS pension. And the average employee works over 20 years for the state of California. If that's the case, and using the 80 to 90% rule of thumb, then the average employee may need to replace 40 to 50% of their pre-retirement income from savings and Social Security. And Savings Plus is a way to help bridge that potential gap. It's important to determine your guaranteed sources of income. If you haven't yet explored what your CalPERS pension, Social Security, other retirement plan balances, and other sources of income might provide, then you'll want to check in with these agencies that control these income sources after you leave today. And you can start by taking a picture of the web addresses on the slide or writing them down for future use. If you have assets in former employers' retirement plans, consider rolling them over to your Savings Plus account. Doing so will reduce the number and probably the amount of fees you pay and make managing your investments easier. Ask your Savings Plus retirement specialist for more information about rollovers. Also included on this slide is the My Income and Retirement Planner. The reason is because it can be an important resource as you consider your retirement income needs. Savings Plus provides this tool on its website to help you through a process that helps you gather income resources and identify any gap that may appear. The more information you provide, the more refined and potentially accurate the information you receive. Just answer a few questions to get your retirement outlook. You can add more details at any time. How to close a future income gap. If you discover that your potential income in retirement is less than your anticipated expenses, don't worry. You are not alone, and the good news is that you can take steps now to shrink or even eliminate that potential gap. To meet your income needs in retirement, you may need to work longer, work in retirement, or increase your savings. And the reality is, working longer or in retirement may not be your decision. Your health, your family situation, and even the economy may not allow it. Depending on these options for dependable retirement income carries risks. You may want to consider that third option, increase your savings now. So let's check out how Savings Plus can make that easier for you. Firstly, who's eligible to enroll in Savings Plus? The state of California established Savings Plus as a benefit for public employees of the state. You are eligible to enroll in a Savings Plus plan if you are currently employed by the state of California or the California State University system, and you are eligible for membership in CalPERS, the legislators' retirement system, or the judges' retirement system. You're also eligible if you separate from California State and CSU system employment and return to service as a rehired annuitant. And the term rehired annuitant used in the CSU system is also known as retired annuitant among state employees. And also, and actually more recently, if you're an active participant in the part-time seasonal temporary employee retirement program, you are also now eligible to enroll in Savings Plus. Savings Plus is a complement to your CalPERS pension by offering 401k and 457 plans that can help you bridge gaps between what you'll need in retirement and the amount that your pension, Social Security, and other personal savings will replace. You can participate in either or both the Savings Plus 401k or the 457b to supplement your retirement benefits. You may contribute to up to the IRS maximum limit to each of them. In 2025, the limit is $23,500, meaning that you can contribute up to $47,000 to your Savings Plus account this year. If you are at least age 50, you can contribute $7,500 to each plan, meaning you could save as much as $31,000 to each plan for a total of $62,000 in retirement savings this year. And in the 3 full years before your retirement year, you can contribute up to double the IRS limit to the 457b plan. This year, that would be $47,000 to that plan, plus another $31,000 to the 401k plan. Now, there are some limits to the limits. So your 401k contributions, including contributions to any 403b and other state-sponsored 401k plans, cannot exceed the IRS contribution limit. Your contributions to all 457b plans you may participate in, including contributions to part-time seasonal temporary plans, cannot exceed the IRS contribution limit. But let's be honest, few of us can afford to set aside $62,000 for retirement savings in a year. The point is, save as much as you reasonably can afford. Participants who are ages 60 to 63 years old by the end of the calendar year can contribute up to $11,250 surpassing the standard $7,500 catch-up limit for those aged 50 and above. This allows for total contributions of $34,750 to 457B, 401 and 401k plans in 2025. This new provision was introduced by the Secure 2.0 Act of 2022 and became effective on January 1st, 2025. Participants who are 59 but will turn 60 within the calendar year are eligible for the special age-based catch-up. Participants turning 64 or older within the calendar year are only eligible for the 50+ catch-up. Enrolling in Savings Plus is easy. There are several ways to enroll. You can scan the QR code here on the screen or go to savingsplusnow.com, input easy to answer information, and get the basics done within a few minutes. You can also text the keyword Savings Plus to 877-697, and you will receive a message that says, "Glad you're ready," with a link to enroll. You can also contact the Savings Plus Solutions Center at 855-616-4776, Monday through Friday between 5 a.m. and 8 p.m. Pacific Time, and a representative will help you enroll. Lastly, you can also simply complete the enrollment form, which is located on the Savings Plus website at savingsplusnow.com. Why investing is an important part of retirement planning. So one of the most common reasons individuals don't invest for retirement is that it carries risks. We'll discuss how to mitigate them in a little bit, but first, it's important to consider the risks of not investing for retirement. And these include inflation risk. Fixed income sources tend to not keep up with inflation. There's also longevity risk, which is outliving your money. And then there's the risk of income gap, and that is not having enough money to live on or live comfortably on. So your CalPERS pension and any Social Security benefit you may qualify for are both fixed income sources. Even if these benefits provide enough income when you begin retirement, over time, inflation will eat away at their value. Your expenses will probably increase as the value of your income slowly erodes. Your pension and Social Security benefits may have cost of living adjustment clauses. If they are granted, they tend to lack the impact of inflation by a year or more. In other words, your benefits will always be working to catch up, leaving you with a little bit less every year. But if you choose to save for retirement through Savings Plus, every payday, your contributions will be invested as you direct to help you grow a supplemental source of retirement income. Any earnings you receive will be reinvested to drive even more potential earnings, and that's called compounding. The more that process repeats, the greater the potential for long-term earnings growth. Savings Plus is here to help you overcome the risks of not preparing financially for retirement through tax-advantaged retirement plans, tools, resources, and guidance that can help you be successful. We say that Savings Plus retirement plans are tax advantaged because you have the option of designating that contributions be taken before or after taxes from your gross income. We discussed the My Income and Retirement Planner a little bit earlier, but I want to go into a little more detail. We're really proud of this tool. This is your all-in-one digital retirement and financial planner that can help not only plan for retirement, it can help with some of the basic financial planning needs as well. It has a guided experience to help you set up your blueprint and all other details to help you plan for retirement more effectively. It is available after you enroll in the plan and log into your account. The short name for it is MERP, and it can be an important resource as you consider your entire retirement needs. The planner will ask you a series of questions to create a retirement readiness report to see your retirement outlook. You can add more details at any time, and of course, the more information you provide, the more refined and potentially accurate the information you will receive. So plan to contribute lump sum separation pay to your Savings Plus account. Contributions are normally withdrawn from your paycheck. However, another way you can increase the amount of assets in your Savings Plus account is to contribute your lump sum separation pay. You want to talk to your payroll analyst to learn what leave counts for separation pay. The reason you should consider this option is because it could give your Savings Plus account a significant boost in total assets available for eventual use as retirement income. That contribution gets invested so that it could potentially generate even more assets over the long term. Remember, retirement can last several decades. You need your money to last several decades as well. You avoid being immediately taxed on that money. You will pay taxes on it eventually, but you get to choose when. When you do take withdrawals, that money will be taxed as ordinary income instead of at the much higher rate for overtime or bonus pay. Plan ahead because unlike rollovers, this contribution does count toward the IRS maximum limit in a given year. To learn more or to access the form, you just go to savingsplusnow.com/lump sum. As you get closer to retirement age, you may notice that a lot of financial professionals are interested in you and your retirement account. The first thing you may want to consider is that you are not required to leave Savings Plus when you retire. In fact, it may be to your benefit to continue your participation in Savings Plus through retirement. You may begin receiving information about transferring your retirement assets into an annuity. Be sure to ask about initial sales commissions, withdrawal, management, mortality, and expense fees, whether any portion of the account value is available for withdrawal, and if there is a withdrawal penalty. Are you comfortable with the stability rating and solvency of the insurance company that is guaranteeing the annuity product? These are just some of the questions that you should think about when thinking about moving to an annuity. If you're thinking of transferring out to an IRA, be sure to ask about fees if you take a withdrawal, what load, sales charges, and expense ratios are associated with the IRA mutual funds, whether the funds are monitored, and what the tax implications may be for rolling over your retirement assets. Are you considering working with a broker or an advisor? If so, be sure you know exactly what fees you will be paying and how you will be charged those fees. Are there additional fees for the investment products they offer? This is not to suggest that none of these options are right for you. They may be, and you should explore them. But allow me to explain why keeping your assets with Savings Plus may be your best option. While you cannot continue contributing to Savings Plus after you retire, by continuing as a participant, you still get all the benefits of the program, including funds monitored for appropriateness for retirement investors, no exchange fees, no commissions, and lower fees than individuals can usually get. And you can still roll over funds into your Savings Plus account, giving you additional opportunities to consolidate and manage your assets to potentially grow as you enjoy retirement. So now we'll go over a few tips to help you boost your retirement savings at whatever age you are. Focus on starting today, especially if you're just beginning to put money away from retirement. Start saving and investing as much as you can now and take advantage of compounding interest, which is the ability of your assets to generate earnings, which are reinvested to generate your own earnings. Contribute to your 401k and or 457b. You can contribute pre-tax money and or on a Roth basis, which uses income after taxes rather than pre-tax funds. You should consider what your income tax bracket will be in retirement to help you decide whether this is the right choice for you. Take advantage of catch-up contributions if you are age 50 or older. One of the reasons it's important to start saving early if you can is that yearly contributions to IRAs and 401k plans are limited. So if over the years you haven't been able to save as much as you would have liked, catch-up contributions can help boost your retirement savings. Automate your savings. You've probably heard the phrase pay yourself first. Make your retirement contributions automatic each month, and you'll have the opportunity to potentially grow your nest egg without having to think about it. Monitor your spending. Examine your budget. You might negotiate a lower rate on your car insurance or save by bringing your lunch to work instead of buying it. Set a goal. Knowing how much you'll need not only makes the process of saving and investing easier, but also can make it more rewarding. Stash extra funds. If you have extra money, don't just spend it. Every time you receive a raise, increase your contribution percentage. Dedicate at least half of the new money to your retirement plan. And consider delaying Social Security as you get closer to retirement. For every year you can delay receiving a Social Security payment before you reach age 70, you can increase the amount you receive in the future. And lastly, this is our contact information. Again, you can contact us at 855-616-4776 from 5 a.m. to 8 p.m. Pacific time during the week. You can also log into your Savings Plus account at savingsplusnow.com. You can reach us by email at sppoutreach@calhr.ca.gov. And then you can also reach me directly if you'd like. Thank you for joining me today. I will go ahead and turn this over to Raquel.
I'd like to thank our panelists for sharing their invaluable insights and expertise with us today. I would also like to thank you all for joining us and taking that next step to learning about funding your own retirement future. Remember, there's no reason to not start early or start now as you continue preparing for a successful retirement. Thank you all and have a great rest of your day.